Hello, and welcome to Your Estate Matters with your hosts, my colleague Greg Bernand and myself, Nicole Garten of Heritage Trust.
Your Estate Matters is a podcast dedicated to everything estates, including building and preserving your legacy.
If it's estate related, we'll be talking about it. We're having the conversations today that will help Canadians protect their families, their assets, and their legacies tomorrow. So, Rebecca, thank you so much for being here with us today. We really appreciate it.
You're very welcome. I'm excited to be here.
So tell us about yourself and how you got into tax.
I'm a tax lawyer. I'm a partner at Scion Law, and I've been practicing essentially exclusively in tax for my entire legal career. I first developed an interest in tax when I was in law school, followed that up by a clerkship at the tax court after I articled. And from there, I knew that tax was where I wanted to be. So I joined the tax group at a large firm in Vancouver and kind of developed from there into the tax practice that I have today. And tax has always been interesting to me as a sort of a puzzle genre or a sort of a problem-solving exercise, right? It's very people-driven, but it's very circumstance-driven, right? So it's every person has a different set of facts, and you're trying to slot people's facts into the rules in the Tax Act to find how those go together in the best way possible for people. I really enjoy that.
Let's discuss taxation on death. What is deemed disposition on death, and how does that impact taxes owed by an estate?
Yeah, so the deemed disposition on death is a core function of Canadian tax law. When a person dies, under Canadian income tax law, they are deemed to have sold all of their assets immediately prior to death and immediately reacquired them at fair market value. So it's essentially a legal fiction that pretends as if you undertook transactions that would cause you to realize all your unrealized capital gains immediately prior to death. So what that means is that there's a tax bill to pay on all the accrued and unrealized gains on your assets. There are certain rules that will mitigate this, such as spousal rollovers, things like that. But for the most part, the bulk of people's assets could potentially be subject to a very large tax bill when they die. We don't have a formal estate tax in Canada, but we have this, which approximates the same thing.
So normally where we would see one of the most large tax bills would be a single person with a giant RIF.
Yeah.
With nobody to roll it over to, and it all comes into income, and 50% goes out the door as a tax.
Yeah, and the RIF is not even as you say, it doesn't get capital treatment. It's all income. So, capital gains are subject to a lesser inclusion rate than regular income, slightly higher now, as the inclusion rate was recently announced that it will be increased, retroactive to June 24th of this year. It used to be that only half of capital gains were included. Now it's 2/3, but it's still less than regular income. So the RIF is probably one of the most painful things, as you say. You can't roll that over to a spouse.
Absolutely.
So maybe let's clarify for our listeners how capital gains change. So the first $250,000, or do you want to?
Oh, yeah. Sorry. Yeah. So for individuals, there's still a safe harbor for capital gains that the first $250,000 of capital gains that an individual realizes in a year, including in the year of death, is still entitled to that 50% threshold. So 1/2 of the capital gain will be included in income and taxed at the applicable rates. And then after $250,000, it becomes a 2/3 inclusion rate. That safe harbor, that $250,000, is only available to individuals. So if it's a company or a trust earning that money, for the most part, that safe harbor doesn't exist, and every dollar of capital gain is included at a 2/3 rate. Those rules technically haven't come into force yet. I think we're waiting for Parliament to resume functioning right now. But the expectation right now is that that's the sort of the lay of the land.
And do you want to tell our listeners there's exemptions, for example, a Canadian-controlled private company, and what the current inclusion is for that?
Oh, the lifetime capital gains exemption. Yes. So if you sell shares of a qualified small business corporation, which is a definition in the Tax Act that requires various things to fit into, but essentially you're looking at an active business carried on primarily in Canada, which satisfies certain asset tests. and certain holding tests for the shareholder as well. If you're an individual who sells those shares and you qualify, you may be able to get a tax shelter from up to, it will be $1.25 million of capital gains. So that's very valuable, very desirable. And that can also be used to offset or to mitigate that deemed disposition on death.
So if somebody has a really large RIF, and I think that goes to our next question, there are ways to mitigate or defer that gain. Do you want to talk about that if it's a spouse or a disabled beneficiary?
Yes. So if you have a dependent that satisfies certain conditions or a spouse, which is the most common, you are entitled to transfer that RIF to that person on a tax deferred, what we call a rollover basis. So without actually incurring the tax, that big tax bill that we were talking about. So the common scenario is, you have a married couple, one spouse passes away and they've designated their surviving spouse as the beneficiary under their RIF. Rather than that tax hitting right away, it will roll to the spouse, the surviving spouse, and it is only on that spouse's deceasement, dying. It's only when that spouse dies that you will actually have a tax bill.
So that spousal rollover is really valuable, but there's often scenarios where you might not want to utilize that. Do you want to?
Yeah. So we were just talking about one of them, which is the lifetime capital gains exemption. If you've got an exemption that means you won't pay tax on a gain, you may as well use that rather than doing the spousal rollover, because with the spousal rollover, you're only deferring tax. You're pushing it down the road. You're kicking the can along, but you're not eliminating the tax, whereas exemptions can actually eliminate the tax. So the lifetime capital gains exemption is a big one. If you have qualifying small business corporation shares in an estate of a deceased person, you want to use that most likely rather than just doing a rollover. If you've got the principal residence exemption and you're worried that the spouse might not qualify down the road, you may as well use that, right? Some other sort of lesser reasons you might not take a spousal rollover would be if you've got capital losses, say to carry forward that could offset the gains, you may as well use those up. Again, anything that can actually eliminate the tax rather than just deferring it is going to be better than taking the deferral of the spousal rollover. And I should say that spousal rollover, it doesn't just apply to a RIF. It applies to any capital property that's going from one spouse to another on death. Generally speaking, there are some vesting requirements. It can't. This can come up in the context of estate disputes. Like if the property doesn't actually vest in the spouse or in a trust for their benefit within a certain amount of time, you might lose that spousal rollover. So it's really important to get the right advice and fit into these rules, because it can be a huge tax advantage.
So we've had some conflictual estates where sometimes the spouse has not triggered the rollover, or have you seen that situation?
Yes, where the will isn't quite drafted correctly to get that rollover. And it may be possible to get that will corrected by, usually you would need a court order for that. So you'd need everybody to agree, which, if you have an estate that's in conflict, it may be quite difficult to get that agreement. So that's where estate dispute advisors become very, very helpful.
But doesn't the spouse have to and you'll have to explain this to us lay people, but tick the box in their tax return confirming that, and there could be a risk in a blended family dispute where they might not do that? I think there was a case where that was a situation.
Oh, because you can elect out of the rollover.
Yeah.
Is that what?
That's
because
what happened.
So you don't have to take proactive steps in your tax return to get the rollover, but you can check a box to say, I don't want the rollover. And as we just talked about, there are reasons why you might not want the rollover, but you definitely want to get the right advice before making that election, because if you don't have any of those sort of advantageous tax scenarios, you may be walking into a huge tax bill without necessarily having the liquidity to pay the tax, right? Because the assets haven't actually gone anywhere. There's no money that's necessarily actually come in.
So that's probably independent legal advice would be required when you're checking that box.
Yeah.
And now we're going from basically what is a federal tax discussion to now what is provincial. What are probate fees?
Well, probate fees, yeah, sometimes people call it probate tax, but it's not really a tax. It's something else. It's its own kind of special thing. Probate fees are government fees that are imposed on the value of assets passing in an estate or under a will where you get a grant of probate. So, without getting into the sort of specifics, essentially above a de minimis threshold, it's a 1.4% fee on the entire value of the asset. So we're no longer talking about that income tax concept of accrued gain here. It's everything. It's that whole value from 0 to 100%. It's important, though, to note that probate fees are only going to apply if assets are actually passing under a will that goes for a grant of probate, right? So if the assets don't require a grant of probate, if no assets under the will require a grant of probate, you may not have to pay probate fees. And it's also not going to apply if assets aren't governed by the will or by a will, or if they don't fall into the estate at all, right? So whether or not you need probate is going to depend on what the assets are and what the sort of, I guess, what institutions they might be held with, right? So banks, large financial institutions, typically they're going to want to see a grant of probate before they start transferring accounts. If you're doing anything to do with real estate, you're going to need a grant to change anything in the land title office. But one of the most common things we talk about that doesn't require probate is, say, you have private company shares. Theoretically, corporate articles could require that you show a grant of probate before transferring, but in practice, it's very rare. And it maybe we can talk a little bit later, I think, about some planning you can do around that. The other thing I was saying was that if assets don't form part of an estate, say the deceased person no longer owned them at death, then those also won't be subject to probate. So that's where you get into some planning opportunities.
So let's talk about what are the main strategies to avoid or reduce probate?
Yeah, so I would say that, I guess, two of the main concepts would be having multiple wills is one of them. So you have one will for all the assets that will be subject to probate, like your land, your bank accounts, things like that. And another will for, we often call it the corporate will, for things like your corporate shares, other assets that don't require probate. There's complexities around that. You have to have different executors. They really need to be carved out and treated separately. And you want to get you want current and technical advice to make sure that that's set up correctly. Another thing you can do is, as I've said, cause your asset to pass outside of a will. So that could be done either by transferring it away during your lifetime, either gifting it to family members if that's what you want to do, although of course there are tax considerations there. You might also transfer property into a trust. We see very commonly people over 65 can set up what's called, we call them life and trust trusts generically, but they're called alter ego or joint partner trusts, where you can roll property in without incurring tax on the accrued gains. And they're now owned in this trust, will be subject to a deemed disposition when you die, but they will not form part of your estate. So it's a very common estate planning vehicle for that reason, because those assets won't be subject to probate fees if that's done correctly. Another type of probate fee planning that we see is people adding family members as joint tenants on properties. So very common among spouses to both be on title. And if you're both on title as joint tenants, when one dies, the other inherits by right of survivorship. There's no requirement to sort of go through a will as long as it's documented correctly. And some people also like to add their kids as an additional joint tenant, but there's quite a lot of complexity around that. And it's sort of a special trust structure, which may or may not require additional reporting these days. There's a lot of trust reporting and compliance rules. So you want to be sure to get current advice if you're going to do anything like that.
So a lot of people think they can just put their adult son or daughter on title and it'll avoid probate. But maybe do you want to clarify for our listeners what the main potential risks are with that strategy?
Yeah, I mean, there are a few. So in order to do that correctly, what you're really trying to do is gift none of the beneficial ownership, because that would constitute a taxable disposition. And you would have to pay income tax on that. So you only want to be gifting the right of survivorship in title to the property. And you can do that. And there's a case called Pecor and Pecor that allows that, essentially bless a structure like that. So as long as you fit within these rules, it may work. But like I said, you want to be careful not to change anything about the beneficial ownership. and you want to make sure that everything is reported consistently, that the only thing this adult child, say, owns is the right of survivorship. They don't get disclosed for, as a sort of an owner of the property for any other purpose.
And I apologize because I know there's a lot of complexity and movement on this, but there are regulatory reporting and potential tax requirements, right? Do you want to just...
There are relatively new trust reporting rules, and I would say these are in flux. And there has been some commentary lately indicating that these PCOR trusts, as we call them, may not need to be reported now for purposes of the income tax trust reporting rules. There's been some sort of some grace given by the CRA lately saying, bare trusts may not need to make tax filings, which I think was well received by many people, but it's a temporary measure in general for bare trusts, and we cannot guarantee how long this will go on. It was announced last year, very, very shortly before the deadline for filing, after most people had already made their filings. And this year it has been announced, a little bit more in advance. But it's a CRA administrative position. It's not actually law. So without getting into all of the details of the various reporting, you'll want to get tax advice on what needs to be reported and where. Because if you're on title to real estate, you have landowner transparency reporting. If there's any companies involved, you wind up with corporate transparency reporting. You have federal tax reporting. You might have the underused housing tax reporting, speculation and vacancy tax reporting. If you're in the city of Vancouver, there's a vacancy tax bylaw as well. Everybody on title winds up having to report under all of these different places. And it can become, the compliance alone can become very costly. And if you're inconsistent across all of these, half dozen different things, that just invites an audit, right? It invites problems with the government going forward.
And adult children get sued.
That too, yeah. There can be liability. It's true, yeah. Yeah, you don't choose the creditors of your children.
Okay. What is postmortem planning, and what are the main postmortem planning strategies people can use to reduce taxes payable?
Yes, so I deal a lot in postmortem planning. Actually, we see this where often where you have a double tax issue arising because of this deemed disposition on death, where there's an asset that has had a gain realized, but there is still potential for further tax down the road. So the most common scenario is where you've got private company shares, right? You have private company, it's got assets in the business or it's got investment assets, whichever it is. Those have accrued gains. On death, the shareholder is subject to tax on the value of their shares. The cost base is increased to fair market value. So if those shares are later sold to a third party, there would not be additional tax except on further accrued gains. But if the company distributes assets or pays dividends, those will be taxed, which could be seen as a second layer of tax really on the same value. And the other thing is that if the company buys back the shares, that's not treated as a capital gain, it's treated as a deemed dividend, which again is calculated differently. So you might see tax again on that value. Because of that, it's very important often in an estate, particularly where you have private company shares, to undertake what we call postmortem tax planning. There are various plans you can implement that will enable you, to basically only have to pay one layer of tax, ideally, right? We're not about, it's likely impossible to eliminate all of the tax, but the idea is not to pay it 2 or 3 times, right? So there are 3 main postmortem tax plans that we use. One is a loss carryback, one is a pipeline, and one is called a postmortem bump. I can get into a little bit of detail on each of those if you'd like. So the loss carryback, where we're talking about an individual who has died owning private company shares, you can, if you do it within the first year after death, right now, those rules may be expanding, but for the moment it's within the first year, you can, if you eliminate those shares, and you cause a capital loss to occur. Some technical tax reasons, I guess, maybe a little bit too much to get into the details of why. But if you create a capital loss on those shares, or if you have other capital losses in the estate, you can carry that back to the deceased's terminal return, which normally wouldn't be possible because the deceased person and their estate are separate taxpayers. But there's a special rule in the Act that lets you do this within the first year. you can carry back a loss in the first year of the estate to offset the capital gain that occurred in the deceased's hands due to the deemed disposition on death. So what you're doing there really is you're eliminating a second layer of tax because ideally we're getting rid of the shares to create that capital loss, but you're essentially converting what was a capital gain on death into a dividend.
Mhm.
And dividends are taxed generally at a much higher rate than capital gains. We do find this helpful still. You wind up with a better tax rate if you have preferential tax attributes in the company. So if you have the ability to pay eligible dividends from, corporate income that was taxed at a higher rate, or if you have capital dividend account in the company, so the company realized capital gains, it can pay out tax-free capital dividends. So
Mhm.
you always want to look at the tax attributes in the company to decide, and that might be advantageous. Where you don't find that loss carryback plan advantageous, if the numbers just don't add up and you
Mhm.
would prefer to keep that capital gain treatment, you can do a pipeline. So pipeline essentially involves selling those bumped up shares to a new company controlled by the estate for a promissory note. And again, as I said, if you're selling to a third party, you're still treated on a capital gains basis. There's no accrued capital gain, so there's no tax on that sale. Now you've got the estate owning a new company with essentially no value, no cost base, because it's got these shares and a debt, and it has a promissory note owing to the estate. And then the new company owns the shares of the old company. And the CRA has blessed these structures with certain conditions, one of which is that that old company has to continue to exist and operate for a period of time. And that promissory note has to wait for payment for a period of time as well. Eventually, after a couple of years, you start to be able to pay down the note and you can collapse the structure and amalgamate the companies without incurring that additional layer of tax. In connection with that, you can often get, depending on the assets of the company, you can often get a bump to the cost base. That's the postmortem bump. That's that sort of third component of postmortem planning. So you can, if the conditions are right and the assets are correct, usually it works on shares or land. It's basically non-depreciable capital property is the technical term. So you can increase the cost base inside of a company to match the outside cost base, which would help you to avoid paying tax again if the company sells those assets, right? So it's, as you can tell, it's very complicated. And it's an ever-moving target, right? You have to examine each client's specific circumstances, each company's specific attributes to figure out what combination of planning will work best. And I would say the ideal is if people have considered this before they die, right? Because I like to say sometimes that we work in pre-postmortem planning, that we really want to set people up in advance of death so that any or all of these structures are available to them to leave maximum flexibility for their executor, the administrator of their estate, to figure out what will be the most tax efficient route.
Now, I've seen one recently where the pipeline was done and there's a very large CRA tax bill owing, and you almost have to liquidate what's inside the pipeline, which is a very painful thing if you have to do that.
Yeah.
And so that, because it was done post-death, not pre-planning post-death. And I guess there may have been an insurance or some other asset set aside to pay that type of tax.
Yeah, that's always helpful. If you know that there's going to be a liquidity issue, to have life insurance in the company that can fund that tax, even if it's, by loaning it up to the estate, if you can't collapse that pipeline in a timely manner, right? Because you do have to leave the pipeline structure in place for a while. Sometimes you can also make a request to the CRA to defer the tax payable if there's a big tax bill in an estate, depending on the circumstances. But it's one of those things where I think the sooner you get into planning it, the better off you'll be.
So say you're a business owner and you want to get in front of this. Who do you contact first? Is it your tax accountant? Is it a tax lawyer? Which professional is the right one?
That's a good question. I don't know that there's a right one to contact first. I think that you probably will wind up with all your advisors sort of addressing together the full picture. So I think it's important to have an estate plan in place. And I think that during the estate planning process, while you're drafting your will, while you're giving instructions to your estate planning lawyer, you want to be talking to your accountant and maybe even a tax lawyer, depending on the level of complexity, about what your assets are, what you think they're going to be in the next sort of 5, 10, 15 years, and how you want them to be distributed and allocated on your death. And that's a really hard thing for people to decide. I get that. But if you don't have those conversations with sort of your whole advisory team at the same time, you may wind up with a disjointed structure, right? Because if you put in place an estate plan that doesn't work with your tax plan, you may have to redo your estate plan and vice versa.
So let's think about the team. You've got an estate planning lawyer, a tax lawyer, an accountant, and an insurance advisor.
Yeah.
Potentially. So what would be a way to get that team moving in the right direction?
Well, as a tax lawyer, I usually like to have a sort of an all hands meeting with the advisors, an introduction, a connection between all the advisors so that everybody's on the same page. And I often find, if you have one of those advisors that has worked with a client long term, they tend to know more than just what's in their lane, right? They know what the client's sort of goals are. They know the client's assets best. And I can't always predict which person that's going to be. I think the key is I love to have just group meetings with the client and all the advisors, if possible.
One thing I would say, there's sometimes maybe some benefit of looking at it from the litigation side, because if it's done post-mortem in an estate, the estate may be subject to a WVA, a Wills Variation Act, which may unwind the entire situation. And that's the litigators will tell you how they'll attack it.
Yeah.
And see if it's worth doing or will actually serve the purpose that it's being created for.
Yeah. No, and that's why I love having estate litigators in our office, actually, because we do run the plans by them. And I'm not the estate planning partner, but when we do estate plans in our office, that partner is always running them by the litigators for that exact reason, right? It's similarly with tax plans. If you've got assets in an estate, they're potentially exposed to wills variation claims, right? Like that's the ball game. And what you want is to provide for a structure that can adapt to the changing landscape.
Yes.
Right?
Yeah. So Greg and I see at Heritage Trust the unfortunately the scenarios where it all goes wrong. Like $2 million of tax owing, complex trust structure, beneficiaries litigating. We're a liquid
3 or 4 years in already when it shows up for a neutral party to get involved, and obviously didn't go the way as planned.
So I think for listeners, I think the idea is get in front of this early, because I think the consequences of not doing that are potential significant delays, paying more tax than you want to, and significant fees on professionals that you wouldn't otherwise have to pay if you'd been more proactive.
Yeah,
I think that's exactly right. Yeah.
So are there any, I guess in that light, are there any final tips you would leave listeners with on how they can minimize tax and complexity in their estates?
Yeah, I would say, it's essential to be having ongoing conversations with your advisors and to make sure you've got up-to-date tax advice, up-to-date estate planning advice and documents. Anytime you're making changes to your structure, or anytime you're having like a big life milestone or something's really changing in your life, you want to be having those conversations and making sure that your planning still works, right? Tax is an ever-changing landscape. It's evolving all the time. Every year there's a new budget. Often there's changes in between budgets. We see proposed changes all the time. And it's really important to kind of keep on top of those, because what you thought might work a few years ago might no longer work for you, both because of the changing tax laws and because your life is changing, right? Think about, say you have a business and you have no kids. What you need from a tax planning perspective might be different once you have young kids and you want to be saving for their future, or potentially trying to multiply the lifetime capital gains exemption. If you've got a business you think you might sell, you could take advantage, or your kids could take advantage of their lifetime capital gains exemptions as well. And then, later in life, say your kids are older, you want them to start taking over the business or taking a more active role. You might be more interested in them holding direct interests in your company, things like that. So, clients' needs change over time, right? Everybody's needs changes over time as their life changes over time. And so between the changing facts of your life, the changing circumstances, and the changing tax laws, I just always recommend people keep in touch with their advisors and let them know so that we can make sure that you're in the best structure possible.
So how can our listeners find you if they want to get the conversation started?
So our website is scionlaw.com. That's SCION. And you can contact me through the website. My email address is rcynader@scionlaw.com. I'm also on LinkedIn.
Thank you, Rebecca.
Thank you
Thanks,
both.
Rebecca.
This podcast is for informational purposes only and should not be considered individual legal, financial, or tax advice. Make sure to consult the advisor of your choice to advise you on your own circumstances. Thank you for joining us for this episode of Your Estate Matters. If you like this podcast, make sure to follow it on your podcast platform of choice.
Whether you are planning your own estate or you're acting as executor for somebody else's, Heritage Trust can help. Partner with Heritage Trust to protect your family, your assets, and your legacy.
If you would like more information about Heritage Trust, please visit our website at heritagetrustcompany.ca.
This podcast is produced by Podfather Creative.